China is denying any progress in the talks with the U.S. Commerce Ministry spokesperson calling the claims of ongoing negotiations, quote, groundless. While President Trump's team touted advances with Beijing earlier in the week, China now pushing back, saying, quote, the U.S. should thoroughly remove all unilateral tariffs if it really wants to solve the problem. So where do things go from here, and what does it mean for investors? Joining us now, Michael Green, Chief Strategist and Portfolio Manager at Simplify Asset Management. Also, Brian McCarthy, the Managing Principal and Chief Strategist at Macro Lens. Thank you both for being here this morning. Brian, I want to kick it off with you because I want to get a sense of the geopolitical aspect here. China throwing cold water on the idea of these negotiations. From where you sit, how likely is it that there actually is going to be a deal between the U.S. and China at this point?
There will be no deal between U.S. and China. If there is any deal, it's an indication that President Trump will have folded under the economic pressure, which could be intense. China will never make a deal that involves rebalancing its economic model. That would require really a change in the entire philosophy of political economy in China. So forget about China making a deal that gives the U.S. what it wants. What is all this really about? It's about global superpower status. Effectively, the U.S. and the West has developed supply chain dependencies that, if they don't already, will call into the question the U.S. ability to deter China from doing whatever it wants geopolitically. So I don't think President Trump would have gotten into this if he wasn't ready for a big battle, and we're looking at one.
So, Michael, how do you respond to hearing Brian say that a deal, it's not likely? What does that mean for markets?
Well, unfortunately, I agree with much of what Brian presented. I would suggest that the Trump administration probably underestimated the impact of the personal and the personality associated with delivering the message. Trump is very broadly despised within the diplomatic corps around the world. That has meant that Europe has reacted negatively, Canada has reacted negatively, even Japan has reacted negatively, and China is taking advantage of that. Ultimately, China is incredibly dependent upon the United States and the rest of the world to absorb the excess production that it needs to create in order to maintain its economic model. I'm a little bit less sanguine on China's ability to extend this for an extended period of time. They have their own internal challenges, but certainly the Trump administration has created the option for them to exploit this. In terms of the market implications, I think, unfortunately, we are seeing that every time positive news comes out on trade, the markets will react positively because they know that's what needs to be resolved. The credibility of the Trump administration in terms of speaking towards settlement or towards progress is becoming less impactful over time. So the rally we had a couple of days ago or yesterday was far less than the rally we had before. Much of that has faded. My expectation is that at some point we're going to have to see this resolve itself, as Brian alludes to, by the Trump administration likely rolling over at this point.
All right, and my guest host, Joe Brusuelas, also has a question for you.
Yeah, I got a question for Brian. Adam Posen, who runs the Peterson Economic Institute in Washington, former Bank of England member, wrote a very provocative article on Foreign Affairs this month talking about the use of escalation dominance by the Trump administration, which is a core tenet not only of game theory, but the escalation ladder and nuclear deterrence. Did the Trump administration escalate actually having all the cards? Or did they not think through what China had been preparing for over the past 10 years?
Yeah, no, I don't think the administration was under any illusions about how difficult this would be. You said the Posen paper was provocative. It provoked me into writing a response that I sent to my clients last week. He said that China's only vulnerability is we're vulnerable because we get goods from China, but they only get money from us. He completely overlooked, Mr. Posen did, that China has very acute balance sheet problems already. And when the money stops, so does the ability to service debt of the firms that were collecting that money. So China not taking in money is a huge problem. They're facing a pincer move from the US now, where China will have acute liquidity problems because its domestic balance sheet, already in bad shape, is going to be put under further dramatic stress. At the same time that they need very abundant domestic liquidity, they are going to see a sharp contraction in the availability of dollars in China because their trade surplus is going to get cut dramatically. And I believe Chinese banks are going to be cut off from borrowing dollars, which they've been doing quite actively from international banks. This is a very bad cocktail for the RMB, and I see China as far more vulnerable than people understand.
Well, I'd like to give you a follow-up. If that's the case, then one, why won't China come to the table and negotiate? And then two, it seems to me the Chinese moved all of the production offshore. That's pretty, elastic, right? What we import from them, we can't get from anywhere else. So how do you cut that Gordian knot? How do you square that circle so that we get to yes on this?
China's approach to these things is always don't talk, fight. So their response would have been entirely predictable to the Trump administration or anyone else. It was easy to foresee. And so if the Trump administration has made a mistake here, it's an egregious one, because China has not done anything you would not have expected. And yes, I'm not saying this is not going to be painful for the U.S., and China's bet is that they can withstand more pain. One ironic thing here is the U.S. needs to stop talking down the dollar, because the pain point for China is their currency. Mm-hmm. And in a weak dollar environment, they can produce more domestic liquidity and kick the can. So there's a catch-22 in what the U.S. is doing here. They need to attack China through the currency because this is a game of who can take the most pain. And China's betting that the U.S. will fold in the short term.
And I've also heard from some of my sources that a weak dollar maybe presents a positive catalyst for stocks. Michael, I want to give you the last word here. Where do you see stocks heading, given all of the headwinds here, plus one that we haven't even talked about, which is that people are buying the dip on stocks that were already perhaps overvalued?
Well, the buying the dip phenomenon is a byproduct of the way that we invest in the United States. As long as you have a job, you contribute to a 401k, your employer matches that. No decision process was involved in that. And we've really seen that play out with continued inflows, particularly coming from retail. The key sell-off that we've seen so far has actually primarily been European and to a lesser extent Asian investors pulling resources home once the Trump administration reminded them that they needed to spend a lot more money at home. That has led to the relative weakness of the US dollar against many of our trading partners. If you're going to try to balance that goods account, you're going to end up hammering the services side and the currency, the financial asset side of the balancing components. The simple answer is that the next stage in this process is the news from companies about how they have been impacted by the tariffs and the disruption to world trade and the uncertainty that's emerging in the United States. As we approach the next earnings season, I think we're going to see more and more information there. My gut reaction at this point is that we will likely revisit the lows that we saw earlier in April and to a certain extent March. And at that point, we'll probably see some form of relief rally that actually starts to take hold. But so far, we're just not really seeing that negative news yet because all the data is delayed.